What's up, everyone? It's Karthik with MoneyVest. We just got the unemployment numbers. Literally, this is fresh, brand new news that just broke out about 4 minutes ago. We were supposed to get the unemployment numbers today, so at 8:30 a.m. Eastern, so just about 4 minutes ago, because it's the first Friday of the month of August, and these were the numbers for the previous month of July. If you come over to the report, we broke 4.3%. We also broke 7 million people that are now unemployed in the United States of America. So if you take a look at non-farm payrolls, we added 114,000 jobs. The unemployment rate consensus range was between 4 and 4.1%. We blew past 4.3. 4.3% is where we are. And I can show you that on my spreadsheet as well. So if we go over to the JOLTS numbers, which came out earlier this week. So this right here was the JOLTS numbers from back in Tuesday. 8.184 million jobs. So if I plug in this number here, 8.184, so 8.184, and then I'm also going to add the unemployed persons. That is how many people are actually unemployed in the US. That is from the participating population that is actually looking for jobs. We just hit over 7.16 million for the first time since coming back since September of 2021, actually October of 2021. So we're hitting a 3-year high in unemployed persons. And prior to this report, we were at 6.8 million. So we somehow managed to unemploy an additional 300,000 people in the US. And if you plug this number in, 7.163, so if you plug that here, 7.163, you'll notice that we're now sitting at 4.3%. This number just got updated, came out 5 minutes ago. And that is, folks, in my opinion, concerning for the market, and rightly for the right reasons. Volatility is spiking over 15%. QQQs dropping like there's no tomorrow. This is the huge sell-off that we are witnessing pre-market right now, down over 2.6%. For the NASDAQ 100, and SPY here also, incurring a bit of a bloodbath, down over 1.8% at the moment. So we are seeing volatility increase substantially. SPY, QQQs are down. If I bring out the extended charts here, extended hours for a lot of these stocks, you'll notice that a lot of them are selling off quite aggressively now. So if you come over to the extended hours for these companies, Amazon now down almost 10%, Nvidia down over 6% pre-market, Microsoft, this entire FANG index, so Magnificent 7 down over 3%, Tesla's down almost 3%, AMD, Apple down over 1.5%, closer to 2% each, Meta's down over 2.2%, Netflix is down over 1.5%. And of course, not to mention a lot of other companies, a lot of other stocks here, semiconductors also down, Intel 25%. A quarter of the company's valuations gone. ASML down over 7.6%, Lam Research down over 5%, TSMC down over 6%, Applied Materials down over 5.5%. So this is a problem. This is a problem because we are now, or the markets now are going to start expecting recession fears. Recession fears are going to start taking over for the market because unemployment rate, as it is accelerating to the upside, as it is going higher. And the cool thing is, I shouldn't really say cool thing, but the Federal Reserve has no freaking clue. The Federal Reserve has literally no freaking clue. Like, they are digging themselves a hole deeper and deeper as, of course, interest rates stay higher and higher. I mean, if you come over to the meetings and if you go over to the summary of economic projections from back in June, right? So if you go over to the projection materials, they didn't even expect unemployment to be above 4%, let alone 4.3, right? So if you come over to the unemployment rate, they were expecting in 2024 for rate to be at 4%. Like, what are they doing? Like, what are they really? What? These are economists. These are people that are paid to analyze and forecast and understand the economy. And not a single person expected unemployment to be above 4% when rates were so high. I mean, the writing was on the freaking wall. Like, unemployment was going to go higher. It was already on its way up. And this is just from a month ago. From last month, they were expecting unemployment to be at 4%. And 4.3% is where we're at now. 4.1% was last month. And this report, we are now at 4.3. And markets are going to now start expecting rate cuts a little bit more aggressively. I feel like there is a possibility for us to see even a jumbo cut in September. Right now, the markets are still expecting about a 25 basis point cut in September. But I wouldn't be surprised if probabilities shift after this report. Right now, only a 27.5% probability for a 50 basis point cut. But as time goes on, as we get more and more data on unemployment, it is possible that we do see a higher likelihood of a potential jumbo cut as well. But the bottom line is the Federal Reserve is going to be in a tough situation. Like, I cannot emphasize this enough, how difficult the situation will be for the Federal Reserve. And as I mentioned before, they're really hoping, they are praying right now that by the time unemployment actually starts going up, as it is right now, inflation would be back down to the Fed's target. Unfortunately, it is not yet. It is not yet down to the Fed's target of 2% or lower, because if we get into a situation, the worst situation the Federal Reserve is going to put themselves in is high levels of unemployment and high levels of inflation. That is the worst place the Federal Reserve can be in. And that would be the hard place, the rock and a hard place, right? That would be the place they would be in if both unemployment and inflation is higher than their actual target. But this is, again, breaking news. Let's just break down to exactly where the unemployment numbers are, essentially what the industries were that got the monthly jobs, essentially the gains over the last 1 month. So total non-farm payrolls, 114,000, of which 97,000 were total private payrolls, and government services were around 17,000. And then if you come over to goods producing, 25,000, service providing, 89,000, mining, minus 1,000. We had construction, 25,000, manufacturing, 1,000, wholesale trade, 4,300, retail trade, 4,000, transportation, warehousing, 4,000. Some sectors losing jobs. So IT sector, 20,000 jobs lost in the information technology sector. Financial services, 4,000. Professional services, business services, 1,000 jobs lost. And other services, 5,000. So a lot of that coming in from service providing sectors and construction. That's good. I mean, that's still pretty good for an economic standpoint. Construction is still up. If you take a look at the last 3 months, construction is up over 58,000, but manufacturing has been going down. Last 3 month net change, we are down 5,000 workers in manufacturing. And if you take a look at the last 6 months, still we're down 13,000 in manufacturing payrolls. So we are shifting a little bit of the tides are shifting underneath when it comes to manufacturing. Construction is still up, which is good. 114,000 jobs added in the last 6 months for construction workers, but manufacturing is still down 13,000. So, it is something that I think everyone needs to pay very close attention to, because if this rate cut is accompanied with a recession, which the likelihood of that is increasing, then the markets are certainly not going to experience any type of soft landing whatsoever. And that's going to potentially lead to a bigger sell-off, because during times of recession, the average sell-off is well over 20%. I mean, a bear market is pretty normal in a recession. But the messaging is clear, right? Use that sell-off, use that market drawdowns as opportunity to dollar cost average. You don't have to, of course, go crazy and go all in every day. You can kind of create a plan and also segregate those, buying opportunities and DCA over several periods of weeks or days or months. But the idea here is that we are seeing significant increase in volatility. Markets rolling over here after this news, after the unemployment report that just came out 13 minutes ago. And now the question is going to once again be, can the U.S. actually experience a soft landing, or if there is going to be a recession? Markets are going to get defensive now. They're going to get very, very defensive. And for that reason, I'm assuming TLT is skyrocketing up. As you can see, 2% higher, huge candle to the upside. Everyone's going to be moving into bonds because there's going to be huge flight to quality at the moment. Markets are getting risk averse. They're getting defensive. Make sure that you drop a like. Let me know your thoughts down in the comment section below. As always, happy investing. I'll see you all in the next video.